Today's video is Taking the Mystery Out of Investing. This is Eileen St. Pierre, the Everyday Financial Planner. The first thing we need to do is make sure we understand the difference between saving and investing. We do tend to use those words interchangeably, but they mean different things. When we save, we want to conserve or preserve our money. We want to keep that money or cash in a very liquid account. And liquidity is the ability to convert these account funds to cash on short notice for little to no cost. But when we invest, what we want to do is make money. So we're looking for potential wealth. We want to purchase assets that increase in value over the years. And we're looking for returns, which are spendable money or profit earned at the end of the investment period. You need to have both adequate savings and investments for financial security. You also have to understand what I call the risk-return trade-off. There's a positive relationship between risk and return. Risk refers to how safe that asset is. What is my chance of loss? So if you want to put your money in a place where it's very safe, you're going to have to accept a lower rate of return or yield on that money. Okay? Now, if you want to make a lot of money, you have to accept some risk. So if someone is offering you a chance to earn, say, 30% a month, there's no risk, that's actually false, right? You want to walk away from that investment. There has to be risk that justifies that high return. Now that we understand the difference between saving and investing and the relationship between risk and return, the next thing you want to do is set your saving and investment goals. And then you want to match that goal with the proper account. Let's go ahead and list some savings goals. Definitely putting money in an emergency fund qualifies here. Also, if you have a large bill due within a year, say a large property tax bill, you want to slowly put that money away so that you have the money to pay that bill when it becomes due. If you want to put a down payment on a home or a new car, or save money for summer vacation. Okay, what all these goals have in common is that they're very short-term goals, right? And the money that we save, we want to keep it very safe. So what we want to do now is match the account to that savings goal, right? A savings account is definitely a place to put short-term money. It's very safe. You can get it out without penalty. You want to keep that money separate from your checking account. Now, savings accounts aren't really paying very much interest nowadays, right? So if you want to earn a little bit more, you could put that money in a money market account or money market mutual fund. You can still get it out fairly easily. Just remember that depending on where you put that money in a money market, you may not get FDIC insurance on that. You may also want to consider a CD or certificate of deposit. CDs have terms, and if you take that money out before that term is up, then you're penalized. So it's not as liquid as these other accounts, but the penalty is normally 1 month's interest, and that's not really a severe penalty. CDs are good to match the time frame of a goal to the term. For example, if you have a large bill due within a year and you have that money now, but you don't want to spend it, if I put it in a 1-year CD, when that CD matures, I take the money out and pay the bill. Now let's go ahead and list some investing goals. Retirement, definitely. Putting money away for your child's college education. If you just want to invest to produce income or minimize taxes. Some people just want to invest to make money, and that's a perfectly acceptable goal. What all of these have in common is that they're more long-term. And if you want to make the money needed, to say, to fund your retirement, again, you're going to have to take on more risk. Now remember, we want to match the goal with the proper account. So when we're investing for retirement, we want to use a retirement account because we get a lot of good tax benefits from that. To put the most money away for retirement, you want to use a workplace plan if you have one available to you. Those would be your 401ks if you work in the private or corporate sector, 403bs if you work, say, for an educational institution, or TSP, Thrift Savings Plan, if you're a federal employee. You can put up to $18,500 away into these plans in 2018. And if you're age 50 and over, you can make an additional $6,000 catch-up contribution. So to sign up for these plans, you do want to contact your Human Resources Department. Now, if you don't have one available to you, or maybe you're a non-working spouse, you can set up an IRA, which is an individual retirement account, and you can put up to $5,500 in there in 2018. And then if you're age 50 and over, you can put an additional $1,000 in, called a catch-up contribution, into these accounts. Now, you have to do some legwork to set this up. You can contact your bank to see if they have a partner that they can offer you an IRA, or maybe go online to an investment company like Vanguard, Fidelity, Charles Schwab. There's a lot of different places where you can open up an IRA. For all of these plans, you have to decide, do I want a traditional account or a Roth account? A traditional account, that's when your contributions are tax deductible in the year you make them. The money grows tax deferred, and then when you pull it out in retirement, that's when you pay the income tax. A Roth account is the opposite. You pay the tax now, and then the money goes in after tax. It grows tax-free, and then when you pull it out in retirement, it's tax-free as well. When it comes time for investing for your child's college education, again, we want to match the goal with the proper accounts. The accounts listed here may have certain tax benefits, or they may also affect your child's ability to get need-based financial aid. Under today's formulas for need-based financial aid, assets that are owned by the student are counted against qualifying for aid more than the assets of the parent. Let's first look at 529 plans. These are offered by states. These are investment plans. The withdrawals from these plans are tax-free if you use them for higher education. However, contributions, you do not get a federal income tax deduction. However, if you open a 529 in your state of residence, that state may offer a state income tax deduction. Your child does not have to go, though, to a school in that state. You can use them wherever you want. You can put a lot of money in these plans. Most offer up to $300,000. And the plan is considered the asset of the parent, not the student. You may also want to consider a prepaid tuition plan offered by your state. Basically allows you to lock in today's tuition rate levels. You just need to remember that it only covers tuition. It does not cover room and board, so you may need a separate investment account for those expenses. There are private prepaid tuition plans out there, and there's a website you can go to, privatecollege529.com, and it will list the plans offered there. Now, many people will just use a savings account open in the child's name, and that's called a UGMA account. UGMA stands for Uniform Gift to Minors Act accounts. This is the asset of the student, though, and only cash investments are allowed. But they're very easy to open at your bank, very low minimum balance. You'll just need to specify a custodian for that account. Just remember, when the child turns 18, they can use the money for whatever they want. It is not specifically geared for college. And finally, if you want to invest, say, in stocks and bonds, not just cash for your child, you can open up a UTMA account with an investment company. UTMA stands for Uniform Transfers to Minors Act. Very similar to a UGMA account in that it is considered the asset of the student, and when the student turns 18, he or she can use the money for however they want to. It does not have to be used for college. You need to be careful if you go to, say, a financial advisor and ask what you should do. Many of them will push the UTMA accounts because they get commissions when you buy the securities. So I just ask you to be careful and consider all of these options available to you. Finally, both with the UTMA and UGMA accounts, the child will have to pay taxes on any earnings. When it comes to the goal of producing income, we all think real estate. Real estate can produce passive income streams, but it does require a large amount of money up front. It may take you a while to accumulate enough property to produce that monthly cash flow that you want or need. For less money up front, you might want to invest in securities that pay high levels of bond interest and stock dividends. You can look for mutual funds and exchange-traded funds, or ETFs, that have income in their name, and that will allow you to buy in for a much lower initial investment. Just keep in mind that all of these assets I listed here are going to produce income streams that are taxable. Now, we've already talked about how we can minimize taxes through the use of retirement accounts, but outside of that, you might want to invest in stocks that pay little to no dividends. Focus on capital gains. If you put money into mutual funds or ETFs, look for funds that have growth in their names. You may also want to invest in municipal bonds because the interest on those bonds is exempt from federal income taxes. This video has been brought to you by the Choctaw Asset Building Program. I hope you've been able to take the mystery out of investing. This has been Eileen St. Pierre, the Everyday Financial Planner.